cracking investors? It is Friday. I haven't done the dates in a while. November 25th, 2022. Had to make sure about the years. They're going by so fast now. But this is the video log. It takes 30,000 to a million. Look. After I show you the accounts, today is a shortened Friday. It's Thanksgiving, Black Friday, post-Thanksgiving, Black Friday. After I do the account review, I want to talk about margin. I want to explain what margin investing is on Robinhood for those of you who might be on the fence about it and are having doubts, which you rightfully should be, by the way, if you don't understand it properly. I'm going to try to do a little analogy to help some of those of you who are considering doing margin investing, to kind of help you think about it and put it in perspective as to what exactly you're doing. So I'll just preview it by saying that if you have a credit card right now and you're spending money on a credit card, you're already basically living on margin to a certain extent. So let's go into it. First, I'm going to show you the account. I'm sitting at 179,440, which is like a little bit less than I had yesterday, mainly due to Apple dropping. So if we scroll down here, you'll see that Apple is the only one that's down 2%. Everything else is kind of up. So we'll see what that's about. There was rumors today that Apple is considering buying Manchester United. How's this camera here? Which is for those of you who don't know, it's a soccer team. It's a football team in England. And it's one of the most high-profile teams out there. I don't think those rumors are true, personally, because I don't know why Apple would ever bother buying a team. A sports team doesn't make any sense. Sports teams usually lose money quarter over quarter, especially Manchester United has been losing money for quite some time now. But I don't want to get too much into it. Let's dive into the account. And I'm sitting currently, like I said, 174. Today I was down like 0.85%. Fine, a little bit up after hours. It's cool. 1 week performance. We'll do relative performance first, and then I'll go over the positions. The 1 week is 1.31. 1 month is 8.26 gain. 3 months is down almost 15%. I think I'm only losing to the market on the 3-month chart at the moment. Year to date is 3.56. 1 year is 5.77. And the all time, I hate showing this chart because I have to say every time I start investing in this account in August 28th, 2018, somewhere around here. That's why there was no money into the account. The high of the account was about 214 on August 8th this year. These are all the positions. You can scroll. I'm going to scroll through them really quickly. You can pause the video player at any moment to try to figure out the exact position. All the information you might ever need is in this little box right here, so feel free to pause and reflect on exactly what my positions are. If you notice, I have a little hobby trade here. I bought a put, although it's a very expensive put. I bought two of them, that expire on December 16th on Manchester United based on these news, because Man U has been just skyrocketing as of late. You can see here it's just a straight line up. On the week chart, it looks like this. So it topped out around 22.67. Right now it's 21, and it's down 30 cents in after hours. So we'll see what happens on Monday. So that's just a hobby trade. I don't think the rumors are true. Although they might sell the team, I don't think that Apple is in it for the running. So we'll see. All right, back to the investment tab here. These are my stock positions. Apple, like I said, down a little bit. Realty Income, Main Street Capital, Paramount Global, and Smith & Wesson. Everything else is up by a little bit. If we go into the investing tab, by the way, this account is completely transparent, so feel free to ask me any questions you have about any of my positions or how the account's going, on the dates, what my strategy is. I'm willing to answer any questions. Completely open, transparent, public account here. So this is the investment tab. You'll see that I have $179,000 of equity. What that means is that if I just completely liquidate the account, I'll get somewhere around that figure. Margin use, we're going to be talking about that in a second, right? It's $112,000 that I've borrowed. And then these are all my positions based on equity first. Apple is the largest one, $103,000, and then Smith and Wesson, Main Street Capital at a third, Realty Income and Paramount Global rounding out the bottom. By total return, Apple, Realty Income, Main Street Capital are the top three. Paramount Global's lost me 10K already. Smith and Wesson 8.8K, so it doesn't feel too good. There's some more stats for you here at the bottom. My standing is good. Margins enabled. Day trade limit. I don't know. I actually don't subscribe to this, but I don't do day trading. I even have even though I'm allowed to, if my account is over $25,000, I'm allowed to do day trading. I actually enabled the strikes here. You see them on the right. I have one strike because I want to actually. It's a way for me to remind me that I shouldn't be day trading a lot, because I think a lot of money can be lost in day trading. I may have a separate video about why that is, even for the trained day trader. But anyways, this was actually a profitable trade. I got like $2 out of it. I can't. It's hard for me to hold on to like short positions. It's really difficult. So going back into the account here, we're gonna do a little relative comparison when it comes to performance. We saw the performance on the account. Now we're gonna compare it to the SPY, which is an exchange traded fund that is basically an index that comprises of the top 500 most profitable, largest companies based off in the United States. So the 1 day performance, I'm losing by a lot. It's pretty flat on the S&P 500. 1 week I'm winning by a little bit. 1 month as well. I think 3 months I'm definitely losing by a ton. So the market is only down 3% over the last 3 months, whereas I'm down like 15%, which is really bad. But on the year, I'm winning. So I had a really good first 3 quarters of the year, whereas the S&P did not. So I've only lately been losing to the markets. The 5-year chart, I'm beating it by quite a bit. So 5 years, market's up 55%, and on the last 4 or so years, I'm up 148. So almost triple the amount of the performance of the S&P 500. So lately I've not been doing too well, but I have been doing really well relative to the market for a long time. Okay, now we're going to talk about, let's go back to the account here, the investing tab, and we'll talk about margin. All right. So what does margin investing mean? Okay. I've had many videos on collateral and borrowing money and things like that, but just to kind of simplify it, my favorite analogy for margin investing is basically taking out a credit card with your broker. Your broker just means, Robinhood or E-Trade or, Thinkorswim, whatever kind of platform you use, interactive brokers. What else is there? TD Ameritrade is a popular one. Webull. So whatever app you use, that's basically your broker. Okay, it's an online broker, and they buy and sell stocks for you upon your command. Now you can take a credit card out with them, just like you do when you bank. If you have a checking account and you have a credit card that's tied to that checking account at the same bank, it's exactly the same relationship. Okay, except you can't use the money to buy a vacation to Hawaii. Can't use it to buy the latest Jordans. Can't use it to buy gas. You can't use it to buy, anything really, except assets that are traded on the markets, which is fine. And I've drawn a little system here for you to help you understand, like, exactly what's going on here. Now check this out. I'm gonna do this live, okay? All right, you watching this? Let's see if it works out. Check this out. Oh, look at all this magic. I just populated this little background. So proud of myself. Okay, so here's how it works, all right? Your checking account is basically, I wonder if you can see my mouse here. Your checking account is basically like the cash that you put into your brokerage. Okay, right? To invest into stocks, first you need to put a cash into your account, and then it can buy stocks. Okay, so let's say you have, $100,000 in that checking account, or 10,000 or 1,000, doesn't matter. So from that account, you can buy stocks. and so you buy some assets, you buy whatever you want. But if you do margin investing, what you do is you get a credit card, right? You enable margin, okay? And you have, let's say, $100,000 limit on your credit card. All right. So what can you do with that credit card is over here. You can spend, right? You can rack up the credit card to $100,000. Let's say you fully rack it up on day one, but in return you get $100,000 of assets. Now these are not $100,000 of Gucci, sunglasses and Louis Vuitton purses. Okay, these are $100,000 of businesses and stocks that you've hopefully bought that are productive. Okay, that spit money back at you. Now, the credit card has interest, right? You pay a monthly interest on your credit card, and this is this money here. Let's say on $100,000, I don't know, I haven't worked out what the rate is, I just picked a random number. Let's say you pay $800 monthly so you can service that debt on your credit card. All right, that's called the margin interest there. You pay an interest payment. Okay, nothing strange here. Now, hopefully, these assets that you bought for $100,000, they don't fluctuate too much, right? And it spits some money back at you in the form of perhaps dividends, or maybe you're selling call options against them, whatever. They spit some money back at you to your checking account. And so at the end of a cycle, let's say at the end of a cycle is a month, perhaps at the end of this month, you get $1,200 from your stocks, from your assets in your portfolio. And you can use that money, right? And then you can pay the $800 owed to the credit card, and you end up with $400 profit basically out of the whole deal. Now, yes, that money is it's taxable and stuff like that, so it's going to be a little bit less than that, but let's just forget about taxes for right now. I wouldn't even worry if you're a beginner investment here, or even intermediate investor. I wouldn't worry too much about taxes. There are plenty of things like tax loss harvesting and whatnot that you could do to minimize your tax bill, but I would definitely not worry about it, especially if you're dealing with small sums. A lot of the taxes at the smaller brackets are pretty insignificant anyways. So unless you're like operating, hundreds of thousands of dollars, maybe even millions in your accounts, I would not worry too much about the taxes that you have to pay on it. Plus, as you go into the hundreds of thousands anyways, later in your life, or perhaps you already do, you will start learning about tax loss harvesting, what that means. But this is not a video about that, okay? I just want to explain margin investing. Okay, so this is basically the little diagram, okay? You have a credit card. It's you make an exchange, right? You trade $100,000 of borrowed money for stocks, and then they pay you back some money, hopefully, right? Hopefully you got money, stocks that pay you dividends back, or you have somewhere recouping some cash, or maybe you sell some off the top. A lot of companies don't necessarily spit out dividends. They perhaps like to buy some of their own stocks, and so that pumps the price of the stock. And so you could just sell some stock and make the same amount of money that you would off of a dividend if they were to decide to spend the money on a dividend. Okay, so don't worry too much about that. Well, actually, what I would do, all right, I'm gonna do this live here, to figure out if the company is spitting money back at you. This is Apple on stockanalysis.com. You want to go to their shares outstanding. Okay, so try to find somewhere where it says shares outstanding, and you can see the trend. Okay, so this is Apple shares outstanding right now, diluted, and you can see that they've been reducing the share count of the company. That means that they buy back shares. This is what that means. Buying back shares is reducing the share count outstanding for the company. And what happens is, if you have a company that's worth the same and you reduce the amount of shares outstanding, the little pieces of ownership that are distributed to all the people, if you buy some of those back, naturally the price is going to go up. So you can sell some off the top and continue to have the same percentage ownership of a company that you did yesterday, or last month. So anyways, that's where this $1,200 comes from. Now, this looks pretty simple, right? And pretty cool, like free money, but it's actually not. I mean, there's a ton of risk that you're doing. Like try living your life racked up on a credit card. It's pretty stressful, right? And having money on margin is also really stressful. I mean, if that $100,000, okay, gets reduced. So let's say we go to, let me see, can you see what I'm doing? Yeah. Let's say this amount, bad economic environment, and it gets reduced to like 40,000, all right? And it stops spitting out so much cash, okay? Let's say it returns you like $600 a month instead of $1,200. Well, now you're at a deficit, right? Now you're paying an extra $200 a month to service these assets that are just going down in value. And it's possible that this gets reduced quite a bit. Okay, let's say to 20,000. Okay, I mean, a lot of the tech stocks have been plummeting, as of recent, for example. So if you're investing in tech stocks on margin, you've probably got destroyed and you've got margin calls. What a margin call is basically your broker demanding their money back. Okay, they're sick of you borrowing on that big credit card. The credit card company calls you and says, hey, you owe us $100,000, give it back now. And the problem is that you don't have that money anymore. Okay, there's a big risk because let's say you had 100,000 here in your checkings account. Let's say you had 100,000. Let's do it. Let's write it out. Okay, you had 100,000, but now because stocks are dropping, not only are you losing money on the assets that you borrowed, but you're also losing money on the assets that you already have with your regular cash. All right, so now what you're left with is just $40,000 worth of assets, and you owe $100,000. And how are you going to service that with negative $400, $600 a month, right? So you're losing $600 a month that you have to work for with your regular job to service this margin debt that you have, and you only have $40,000 in assets. So your brokerage is going to see this, and they're going to be like, hey, BT Dubs, you owe us 100K, you only have 40K, and we don't think you're going to be able to service this huge debt. So we're going to sell off the rest of your assets to cover some of our losses, right? And it is their losses. Like when they sell off your entire account here, your entire, whatever you bought with your checking account or your brokerage account and whatever stocks and assets you have with borrowed money, when they sell these off, they're left with a $60,000 loss. All right. So not only going down to zero, but the credit card or the brokerage company takes a $60,000 loss as well. So everybody is feeling super bad. You just lost your original 100K that you entered into your brokerage. The company that you took margin out with also lost 60K. And not only that, but now you're selling your 40K in the market. It's forced selling. So when you hear the term forced selling in FinTwit or somewhere where they talk about forced selling, that's what it means. So not only that, but market is experiencing a $40,000 forced selling that it wouldn't have occurred otherwise, which pushes stock markets down, and other people tend to lose money because of that action. So it's kind of a vicious cycle, right? Everybody loses. So if you step over the line, you borrow too much, you can't service the debt, everyone loses. You lose all of your money. The brokerage firm loses some of their money, and the market participants that are invested in the same stuff that you are lose some of their money and perhaps even all of the money like you. So everyone loses. It's a really bad situation. So you never want to take out margin that you're not 100% confident. Well, nothing's ever 100%, but close to 100% confident that you can service that margin without your asset value decreasing too much, right? You don't want your assets to decrease. You don't want this number to go down, okay? So whenever you check out your margin account, it's going to move up and down quite a bit more, double basically the volatility that a normal account would experience if you're levered up 100%. So you can expect that. It's quite a bit risky. So if you're just now dipping your toes, like instead of racking up the credit card all the way up, if I were you, I'd maybe rack it up 5-10% just to kind of get a feel of what it feels like to borrow money and buy assets with it. It's much better to do that than spend the money on consumer goods, I tell you that much, from your financial standpoint. But that's what margin investing is. I hope I did a decent job at explaining it. I know I don't do any edits. This is a straight cut, like grab a drink and sit and chill with me and just explore topics kind of deal. But if you have any questions about it, just let me know. I like to do videos like these and help people with their investing knowledge a little bit from time to time. I also like to do little shallow company reviews on the weekends for fun, sometimes even during the week. But hopefully, if you're in the US, you had a great Thanksgiving, and I'll probably make another video tomorrow or the next day, or maybe even on Monday when there's some action to talk about in the markets. All right, that's it for now. Peace out.